Good morning. This is X-Pulse AI Morning Mix. Today is Monday, May 18th, 2026. We're tracking a power shift in the AI model market, a bold automation timeline from Microsoft, and two pressure points in chips and data centers. I've got Orion with me, ready to jump in.
Absolutely, let's do it.
We start with the money. The information reported on May 17th that OpenAI and Anthropic now account for about 89% of revenue among a group of 34 leading AI startups. Orion, what stands out?
Two things: scale and concentration. The group overall is near $80 billion in annualized revenue, about $6.6 billion per month, but nearly all of it is flowing to the top two model makers. That widens the gap for everyone else trying to sell just a model.
Is this simply best models win, or is there a structural lock-in happening?
It's structural. Once enterprises standardize on one or two platforms, identity, security reviews, procurement, fine-tuning pipelines, switching costs jump. Add bundling, models plus tools plus agents plus support. The middle gets squeezed into either niche models or application layers.
So, if you're a smaller AI startup, where's the oxygen?
Either go vertical with proprietary data and workflow ownership, or become exceptional at integration and outcomes. Competing head-to-head on general-purpose capability against OpenAI and Anthropic is like opening a corner store next to a warehouse club.
Staying with the workplace, Mustafa Suleyman, Microsoft's head of AI, told the Financial Times, as reported by the Irish Examiner on May 17th, that many office jobs could be automated within 12 to 18 months. Orion, should we take that literally?
Take it as a directional forecast with a sharp timeline. Routine tasks, triaging email, drafting documents, updating systems, basic reporting, are already getting good enough with agentic tools. The constraint is less model capability and more deployment, permissions, change management, and process redesign.
What does automated look like in practice? Headcount cuts or task reshuffling?
Mostly task reshuffling first. You'll see roles split into two: people who supervise exceptions and judgment calls, and systems that do the repetitive execution. Some functions will shrink, but many will morph into operator plus auditor jobs.
And the risky part for companies.
Assuming automation equals instant savings. If you automate a messy process, you just get messy outcomes faster, now with more confidence and better punctuation.
So the timeline is plausible, but the real work is organizational, not magical.
Exactly. Technology is accelerating, but adoption is a systems project.
On the chip front, Tech Times reported on May 17th that the U.S. Federal Trade Commission has opened a formal antitrust investigation into ARM, tied to ARM's first chip launch. What's the core concern?
ARM historically licenses CPU architecture to almost everyone: Apple, Qualcomm, Nvidia, and many others. If ARM becomes a direct chip competitor, regulators worry it could disadvantage licensees by raising prices, delaying access, or degrading licensing terms.
Is this about ARM having too much leverage as a platform?
Yes, ARM sits in a choke point. Even subtle changes, like which partners get early roadmaps or better optimization support, can shift billions in downstream device and data center markets. The FTC is effectively asking, can ARM compete and remain a neutral Switzerland?
What would a heavy-handed outcome look like?
Behavioral remedies, non-discrimination rules, stronger auditing, stricter separation between licensing and ARM's own chip unit. The biggest risk is uncertainty. Partners may hedge with alternative architectures if they fear the ground rules are changing.
And the market's big calendar item. YNet News reported on May 18th that Nvidia reports fiscal first quarter results on Wednesday, and investors are treating it like a read on AI data center demand. Orion, what are people listening for?
Guidance and backlog quality. At around a $5.5 trillion valuation, the question isn't did they beat, it's does demand stay durable, and are customers still ramping CapEx for GPUs and networking? Any hint of digestion shows up fast.
What signals matter beyond revenue?
Cloud concentration, lead times, and whether orders are tied to long-term build-outs versus short-term experimentation. Also watch commentary on inference, serving models at scale, because that's where efficiency gains or pricing pressure can change the math.
If the numbers wobble, does the whole AI trade wobble?
Usually, yes. Nvidia is the market's proxy for is AI real spend or hype spend. One quarter doesn't change the trajectory, but it can change the mood, and the mood moves budgets and boards.
So Wednesday is less a scorecard, more a confidence check.
That's the right frame.
A few faster hits to round things out. Yahoo Finance cited a Gallup poll on May 17th. 71% of Americans oppose AI data centers near them. How big a blocker is local backlash?
It's a real throttle. Permitting, power, and water are already tight. Community opposition adds years. Companies may shift towards smaller distributed builds, repurpose existing industrial sites, or push harder on clean power plus jobs packages to win approvals.
Meanwhile, CNBC on May 17th looked at 23 S&P 500 firms tying layoffs to AI and found 13 traded lower afterward, with an average drop around 25%. What's the market saying?
Investors want growth, not just cuts. We fired people because AI reads like a one-time margin story unless you prove durable revenue expansion. If the product roadmap doesn't scream new demand, the stock often shrugs or punishes the uncertainty.
Two more. Michigan issued K-12 guidance on May 16th via YLX, focusing on privacy and human oversight. And Live Mint on May 17th says forward-deployed engineer postings surged 729% year over year. What connects those?
Control and implementation. Schools are drawing boundaries. Humans stay accountable. Companies are hiring people who can turn models into working systems inside real constraints. Forward deployed is basically bring the AI to the messy reality, not the other way around.
Also, Tech Times on May 16th says Anthropic published a founder's playbook and launched Claude for small business with workflows tied to tools like QuickBooks, PayPal, HubSpot, Canva, and DocuSign. Is this the new distribution play?
Yes, packaging agents as business software, not developer toys. The winning move is embedding into where work already happens, with pre-built actions and permissions. If it's click to deploy, adoption jumps, especially for small businesses.
And Capital Plus Markets. A World Economic Forum report covered May 16th by Let's Data Science flags about $3.2 trillion in unrealized value in private markets. Kalkin Media on May 16th also noted AI stocks sliding on valuation and infrastructure debates.
That's the same pressure from two angles. Liquidity is tight, and public markets are demanding proof of efficient spend. When exits slow, private valuations get sticky. When Nvidia-like signals wobble, public multiples compress. Everyone suddenly cares about cash flow again.
That's XPulse AI Morning Mix from XPulse for Monday, May 18th, 2026. Share it with someone who'd find it useful. See you next time.